It's always hard to know why the markets do what they do, but if you look back last year to the surprise political events, Brexit, the US election, whatever the market response was, it was kind of not quite right. And the economies continued to be fine and the markets did fine. So it's possible the markets are just reacting to the non-events of the past.
And of course, hedge funds' main complaint is that the volatility, the regime that we've been seeing over the last few years has actually been detrimental to hedge funds, which of course plays into that bet and that humble pie that Michelle was talking about before with Buffett. Now, as of yesterday, we're seeing actually the HFR index outperforming the hedge fund index, outperforming the S&P through the month of April for the first time in 10 years.
Yeah.
Is the bet that you made one that could reverse itself for the next 10 years, given that trend that we're starting to see?
It's very easy to grasp the word could. Could hedge funds beat the market over the next 10 years? Of course. Anything can happen in markets. Those two are very different things, and I talked about that 10 years ago and talk about it today. Hedge funds really don't try to beat the market. They're really trying to deliver a nice equity-like uncorrelated return. But could it happen? Sure. And how might it happen? These types of market conditions, higher interest rates, more volatility, are certainly more conducive for differential returns and security selection. And that's where hopefully a talented manager can deliver the value add that they try to for their investors.
Well, certainly some hedge funds try to beat the market. Some hedge funds try to deliver alpha. That's the main purpose that they tell their LPs of their existence and the justification for paying the 2 and 20 fees. And when you bet Warren Buffett, you took a basket of fund of funds and related it to what Warren Buffett was betting in terms of the index and looked at the outperformance there. Is what you're saying, am I understanding correctly, that the purpose of hedge funds has shifted over the last 10 years and that those uncorrelated returns are becoming much more of a value proposition for their investors?
Well, that probably was always the purpose. I can't speak for the lion's share of investors, but most of the institutions I talk to on my podcast really are focused on hedge funds as a way of delivering an equity-like return stream that has either less or low correlation to the markets. That was the case 10 years ago, and it is today. So to make that direct comparison to the S&P is a little bit of an apples and oranges comparison.
They're a different asset class.
Yes.
Even long-short equity, you not compare that to the S&P.
There's more correlation in long-short equity for sure, but again, it's not quite what hedge funds are trying to deliver.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.